Hello, good afternoon. My name is Miguel. Hope you guys could hear me well. It's a pleasure to be here today to talk to you guys about the markets. It's been such a day in the stock market today, but today I have the pleasure to be here with you guys, tell you a lot about what's happening in the markets. The goal today is just provide some lights, because right now when you look at the markets, a lot of noise out there. And so let me share my screen with you guys just to break down what's going to be the agenda for tonight. So just overall, we'll be talking about 2025, the stock markets, and we'll be talking about basically how the performance it has been throughout the year. We'll look at fundamentals, basically technicals as well within the stock market. And as well, we'll talk about history. And for you guys that don't know me, I'm Miguel Rodriguez. I'm the other Miguel for our clients. They know me as that. I'm one of the senior wealth advisors. I've been here in Guerra just for about 4 years already. I had the pleasure of working with a lot of the families, servicing them and just providing just the best possible outcomes for their financial plan. But so today's basically conversation is just, again, we're going to be talking about different things, but I want you guys to really understand when it comes down to these things that are happening in the markets, you need to have a financial plan. And if you don't have a financial plan, that's something that we could sit down and basically go over. And if you already have a financial plan and you're one of our clients and you don't feel secure about what's happening out there, let's sit down, let's book a financial review and go over those things. Well, now let's start from the top. For the people that don't know us, basically we're Guerra Wealth Advisors. We manage around $800 million. We work basically with Fidelity Investments. Most of our clients know them already. So just very over the top, just going over that real quick. But let's get into it. Now, 2025. When you guys look at the news, right? It's so divided right now. Depending what channel you guys look at, either everything's going very well or everything's going very bad. But you have to basically zoom out at the end of the day. So let's look at the stock market right now. How has it reacted since the year started? Now, we have basically different benchmarks. We have the S&P 500, which are the largest 500 companies in the United States, we have as well the NASDAQ 100, which are the largest 100 technological companies in the US, and we have the Dow Jones, the largest 30. Let's look at how they have basically performed going down from January 2025 up to today. So right now, if you guys look at the Dow Jones, it's down 4.55%. If we look at basically the S&P 500, we're down 7.22%. And if we look at the NASDAQ, tech right now is down 11.32%. Very scary. If you guys look at it, we had a very good trend on the beginning. And then over the last couple of months, because of tariffs, which don't worry, we'll talk about them. How do they affect the markets? And basically, for our clients as well, what are we doing with the portfolios? But if you guys look at over here, all this volatility has been happening right after March. But let's zoom out a little bit. Let's understand what happened to the market over the last year. Let's not just emphasize on this year. Let's zoom out a little bit. Now, if you look at the S&P 500 over the last year, it's up 4.89%. The Dow Jones 4.41%, and you could see this here on the top left, and the Nasdaq basically 5.36% in terms of performance. But look at all the volatility of all the different things that has happened over the last year. And I want you to keep an open mind. When you look at the news, they're always going to be selling you something. There's always going to be fear out there. You have to really understand how is your money invested? What is the purpose of your money? What is the overall financial plan that you have right now? But let's zoom out a little bit further. Let's look at the last 3 years. If you look at the S&P over the last 3 years, it's up basically 21%. The Dow Jones itself is up 16.96%, leaving the NASDAQ at 24.90% for the last 3 years on average. Now, if you zoom out, you could already look at the volatility starting to be lesser in that sense. Now, still, you see the ups and downs with the markets, but we're still up over the last 3 years. And let's look at the last 5 years. When you zoom out a little bit, the S&P 500 over the last 5 years, it has done 98%. The news are not telling you this. The news are basically selling fear. Look at the Dow Jones, it's up 73%, and the NASDAQ is up 111%. But Miguel, I understand we have been going up over the last 5 years, but what is happening with the market right now? Why are we going down so fast? Now, let's talk about a couple of things first. Let's break down the market itself by sectors. So right now, what you guys have in front of you, here are all the sectors within the S&P 500 with their performance year to date since January started. Now, if you're one of our clients, today is a great day to look at your accounts. Look how the market performed. We have basically information technology up 14% for the day. If you guys looked at the news, which I know some of my clients might be laughing right now because I tell them not to look at the news, but I know you guys are looking at the news. Basically, Trump delayed the tariffs. Now, basically right now, tech is up 14% for the day. If we look at utilities, 3.91%. Let's look at as well materials, 8.63%. It was a great day for the stock market itself, and that allowed some pressure to be taken off from the portfolios in that sense. But now, look at the last month. Over the last month, most of the sectors are down. Over the last 3 months, most of the sectors are down as well. And year to date, most of the sectors are down as well. But let's look at basically over the last year, mostly is down, except a couple sectors, which I'll talk about that now. Over the last 5 years, everything's green. And over the last year, everything's green. Now, Miguel, what are you guys doing with the portfolios? So me and Miguel Castañeda, a lot of our clients know who he is. He's another senior wealth advisor. Basically, when we're making decisions about the portfolio, we can't just look at today. We have to look at the future as well. So what are we doing basically to fight this volatility that's happening right now with the markets? So historically, in moments like this, that there's a lot of fear out there, defensive sectors tend to do very good. Miguel, what are defensive sectors? Sectors such as consumer staples, healthcare, utilities, and basically energy as well. Defensive sectors historically are sectors that the consumer needs, that are always profitable. They're making money during times that the economy is not doing so good. Here's what I tell my clients. So the utilities, everyone has to pay for the light bill. If you look at over the last month, one of the best performing sectors, when I say best performing, I'm meaning that it hasn't gone as down as other things, is utilities. Look at it over here. Utilities is down 4.98% over the last month. But look at technology, it's down 18% over the last month. So switching within the sectors is something that allows to minimize the downside. So we call that sector rotating. According to what's happening out there fundamentally, and with the technicals of the stock market, we're making decisions and switching within the sectors. We like to call that basically tactical allocation. It's not only about putting all your money into one sector. That's not really diversifying. You have to be smart how you're doing these things. And you can't just move all at once. Because remember, clients, we have taxes to pay as well, capital gains. So understanding your portfolio as a whole, right now when the market is down, that creates different opportunities. Number one, basically you could sell different investments that had a huge capital gains. You could do some tax loss harvesting, setting something that it's at a loss now and trigger something that's at a gain and do a wash and reposition that money into something that you believe is going to keep going up over the next 5 to 10 years. It's a great opportunity to do so. I'm going to throw you a curveball. Now, when we talk about taxes as well, let's say we have an ETF. An ETF is a fund that has hundreds of companies inside of it. Let's think about the S&P 500 ETF. Let's assume, which is not the case, but let's assume for the sake of the example, the S&P 500, the value of the ETF is $100 per share. And let's assume we have 10 shares. The market goes down 20%. You still have 10 shares, but now the value of that ETF is basically $80. You should meet with your advisor, your wealth advisor, and talk about conversions, because when the market is down, you could shift more shares at a cheaper price to your Roth IRA. And when the market goes back up, you're getting all that appreciation tax-free. Now, you have to be smart, because when you're doing so, you're paying taxes. So you have to do what is called a bracket analysis. Make sure that when you're doing these things, you're aware at the end of the year, when you're paying your taxes, how comfortable does that make you feel? And what are the tax savings over the life of the plan? By the way, I didn't mention this. You guys could drop down your questions. I'll be looking here to my right to see if I have any questions in the live chat. We're going live on Facebook, on YouTube, and different platforms. The goal is just to inform you guys as much as I can. And I know I'm going a little bit fast. I just love the topic. And I want to bombard you guys with the information just to basically give you an understanding of what's happening right now and not put all your energy on the news. But anyways, going back to the sectors of the stock market right now. When everything is down right now, everything seems like a scary movie. You turn on the news, like I said, depending on what channel you're watching, it's either very good or very bad. Just sit down with your financial planner. Understand how is your money invested. What sectors are we using within your financial plan? Now, so let's move on to this real quick. Let's talk about tariffs. This is the topic of the hour. And people think that this has happened. This has never happened in the history of the United States. It actually has. So I went back on history with my team, and we went back to 2002 when tariffs were implemented for steel. So basically, the idea was the governments implemented this to protect the steel manufacturers of the US. And let's look at how the stock market reacted to this. So on the purple, we have the S&P. So let's be very transparent. When tariffs are applied, they're basically a tax. So we have to really understand that. The idea behind this is protecting the consumer. But let's see how the market likes this. If you look over here, in May of 2002, the market didn't like it so much. It went down. And then it bounced right back up around January. Then it went down. And then in a matter of a year and a half, it went up. It ended up being basically flat. So, and look at Ford. Here's the important thing. Why you need to be basically diversified. So if you look at Ford went up. When this news hit the market, Ford went up, but then Ford melted with the stock markets. And then it went as down as almost 60%. Then it rallied back up very fast. But now, Miguel, have we been on this before? And basically, yes, we have. Let's look at another time period, 2018. We had basically in 2018, the same administration that we have right now. Because you have to basically not look so much at the politics, you have to look at policies. How do the policies affect the market and how those policies affect certain sectors? So going back to tariffs, if you guys really think about it, if we go back, the sectors that have been affected the most because of the tariffs have been tech. Why? Because all the importing that happens. So we have to be aware of that as well. But now with the tariffs being delayed, the news hitting the market today, look at the best performing sector that gets affected by this the most. Tech rallied very fast and consumer discretionary. Think about consumer discretionary. This is a sector that basically people are buying goods that they don't need to survive. So in times like this, that there's fear, the consumer is not spending as much money. That's why that sector over the last 3 months is down 22%. And now that tariffs got delayed, it rallied. So what am I saying? Diversification, understanding how these sectors are split within your portfolio and what is the purpose behind that. So let's go back to this, 2018. So the S&P 500, when tariffs were implemented, basically all this argument that was happening with China and Trump was putting this on China, the market sold off. It went as down as 10%. Then it rallied back up, it recovered. Then it went as down as 16.65%. And in a matter of a couple months, a quarter, it ended up being positive. If you would have sold off as low as 16%, you would have realized the loss and you wouldn't have participated on that bounce of the markets. So I'm sorry, I'm looking at some of the questions here on the chats. And I see one of the clients over here. So I see Emma Arana asking a great question, which is one of our clients. How about switching the volatility of stocks into bonds? That's a great question. So bonds, if you look over here, actually, Emma, look at bonds. You see the Bloomberg. So when tariffs were happening, bonds tended to react good, and it lowered down the volatility of the portfolio. So make sure that as you guys are speaking to your financial advisor, there's safe buckets, there's risky buckets. You guys know how we do the planning. Within each bucket, there's different vehicles that you could use to battle the volatility of the stock market. Bonds is definitely an option, but you have to zoom out as well and see how bonds they have performed over the last 5 years. But now, going back to bonds during this time, it basically lowered down the volatility of the stock market and it ended up doing better than the actual S&P. But now, let's go down now to fundamentals. So fundamentally speaking right now, let's talk about interest rates. So interest rates is a big deal for the stock markets. When you raise interest rates, you're taking money away from the money supply. Business owners, when rates are high, they can't borrow as much money from the banks. When business owners borrow money from the banks, so let's think about Sebastian borrowing money from the banks. At that time, he could reinvest it back into the business. he could hire more Miguels, he could hire more employees, he could invest more money into the company to grow the company. When you hire more employees, basically you're giving people employment. When you give people employment, now Miguel has a job, he could go to someone else's business and spend money on. So when rates go down, that's a good thing for the economy. They're pushing for expansion, for the economy to grow in that sense. Because as rates go down, historically, the markets tend to do very good. The stock market tends to rally. But the Fed, Jerome Powell, who's the chairman of the Federal Reserve, and Trump, I know politics, I keep going back to it. I want to stay out of it, but we have to talk about it. We have to address everything that's happening. Trump and Jerome Powell, they don't really historically see eye to eye. One of them wants to lower rates too fast. The other one wants to hold off. And they're pushing each other to see what they do. But the reason why Powell is being careful with interest rates, if they lower interest rates too fast and they inject too much money into the economy, that could cause inflation, our good old friend inflation, to go back up. And if inflation goes back up, the Fed at that point will have to raise interest rates again. So that's setting us back. So they have to be very careful in that sense. And right now, over the last couple of weeks, with all this volatility, which we'll talk about that now, the CME Fed Watch tool, which is a tool that we use, which is basically predicting how fast are they going to lower the interest rates. And right now, with all this volatility, basically, they're looking to lower rates. Now, how fast? We don't know. But look at this over here in the screen. Right now, the Fed funds rates, the futures, what I'm talking about, this prediction of where rates are going to be, they're lowering rates throughout the year as of right now. Now, at the end of 2025, rates are predicted to be around 3.32%. I'm sorry to break it to you guys. This does not mean if you go to the bank to get a mortgage, you're not paying 3.32% for a mortgage. That's not really how it works. Now, at that time, hopefully mortgages go down as well, because I have a lot of clients and I met with a lot of families that over the last couple of years, they have bought homes and their rates have been over 6 to 7%. I know a family that paid around 9%. So the idea is to refinance those debts to more beneficial interest rates. So I have a question over here. Which sector has getting affected the most with the trade war with China? I did mention a little bit. Right now, it's been tech over the last couple months. But again, you can't really just because tech went down over the last month does not mean you have to stay away from tech. By tech going down as well, that also creates a buying opportunity. You have to think about it both ways. You have to understand what is your time horizon as well. So time horizon meaning how much of this money you need within the next year, 3 years, 5 years, and 10 years. And what does this money means for your overall financial plan? If this is all the money that you have right now for retirement and you have all this money in tech, that's not really a good idea. That's why you have to have it in different buckets and in different sectors. You have to be very cautious with that. So I hope that answered your question. Now, let's talk about inflation. So there's something called trueflation. So we don't only look at the CPI that the government puts out there. This is an independent source that it looks at live inflation for the consumer. And right now, inflation is very low. I know, guys, if we go to the market, you're spending a lot of money for eggs. Inflation going down, it doesn't mean that the cost of eggs is going to go to $1. It means that moving forward, the cost of eggs is not going to go up as fast. So inflation being down right now is a very good sign, basically, for the Fed to lower interest rates. That's a very fundamental thing and very good for the stock market. So let's look at jobs. So jobs, the job market right now, it's pretty strong. So if you guys look at it right now, the Fed likes that. The recent reports that came out, it's showing that the economy is not doing as bad as it seems. But now here's the thing. If you look at the job market right now over the last couple of months, with politics and everything that's happened, it's ticked up a little bit, as you could see over here, because all the layoffs that happened. But as of right now, that hasn't really affected the stock market as much, but we have to be aware of that because it could. Now, let's look at the news. This is everything that's being put in your face right now. Like I said, the news are there to sell fear. The more fear that they sell, the more eyeballs are watching the news. That's how they make money. They're not going to tell you that the stock market over the last 5 years is up over 50%, over 70%. They're not going to tell you that. They're going to put all the news in front of you, so you could they could bombard you with news, and you could be there watching with them. You can't just make irrational decisions when the news are hitting there. So don't make decisions just based on the headlines. Emphasize on what is the purpose of your money and how is your money allocated within your financial plan. So let's look at a couple of things. So I love this right here because I'll show you why. Let's look at some headlines that has happened throughout the history of the US. 1977, inflation spirals, savings and stocks to vanish. Very scary. Let's look at 1976. Oil shock crushes hope. Market face a wipeout. That's 1976. You guys could read all of this right here. 1950, basically market doom. Very scary. 1935, meltdown fears. So these are all headlines that cause a lot of people to make basically, let's call it, not the best decisions at that time and sell off in the markets. They basically made an emotional decision because with the stock market, you have to have a whole plan at the end of the day. If you sell off and the bounce happens, you realize the loss in that sense. Now, let's see how the market reacted to those headlines. That's the biggest takeaway from this. So, got it. So inflation, savings, and stocks to vanish. The S&P 500 did 7% for that year. Fantastic. Missile crisis. Wow. There's no hope. The S&P 500 did 8% for the year. Cities burn. The market is gonna get wiped out. It's gonna collapse. Market did 12% that year. Wow. 1950, the market doomed. It didn't really doom. It did 31% for that year. Now there's an economic meltdown back in 1935. Market did 47% that year. So if you put all your energy into the headlines and you don't look at what's happening with the actual economy and understand what percentage of your money is actually exposed to those things that are happening, it might lead you to make a bad decision. Don't get influenced by the headlines. Understand basically what's happening with your financial plan and with your portfolio. So let's look at this. Let's look at reasons why to sell. Going back to the 1990s. 1990, we had a recession, a good reason to sell. Let's look at the Asian financial crisis, another good reason to sell. The dot-com bubble, great reason to sell. So let's look at here. Hurricane Katrina and Rita, the Lehman Brothers. You guys see this gray area right here? Those are recessions. That's where the market went down as well. But look how the market bounced back. Basically, let's look at the COVID. Market went down. Inflation at 9%. I know a lot of you guys lived through that. It was not pleasant, but we got through it. 2024 elections. If you guys look at since the 1990s, the market has done over 3,000%. So analyze at 10.59%. So basically right now, there's always going to be a reason to sell. Always. The headlines are always going to be there. So you have to be smart with your financial plan. You can get really influenced and go cash. Because when you go cash, that's when mistakes happen. So let's go with that. I got some data for you guys. So let's look here first. Let's look at the right side. I like this one. So what happens if you go cash? Going back to the 1995. If you have basically $10,000 invested into the stock market, the S&P 500, very simple index, going back to 1995, and you miss the 10 best days of the stock market, going back to 1995, your returns get cut in half. Instead of having, if you would have fully stayed invested, $224,000, you would have had $102,000 by just missing the 10 best days of the stock market. With all the respects to me, to everyone in the industry, no one has the crystal ball to see when those days are going to happen. Look at today. The market did over 7%. The NASDAQ did 12%. An amazing day. If you would have gone cash yesterday and sell all your investments in the markets, you would have missed that rally of today. Who would have known today the tariffs will get paused? And if someone tells you they knew, I don't know about that. They have direct connection with their White House. And if they have that phone number, to send it to me. No, I'm kidding. So, but let's look at this. If you miss the best 20 days going back to 1995, you will have 73% less of the value if you would have stayed invested. And if you miss the 30 best days, you will have only $38,000 compared to $224,000. Now, I'm not saying to stay within 100% of stock market. You have to have a financial plan, But you guys get the idea. Timing the markets is very tough. The biggest hedge funds cannot do it. But let's look at this. Now on the left side, 50% of the best days in the stock market happens during bear markets, happens when the market is down. The market bounces very fast. Basically, 28% of the best trading days happens between the first 2 months of a bull market. And the other 22%, it happens during the remaining of the bull markets. So what am I telling you? When the market is down, the bounce back happens very fast. And if you don't catch it, let's talk about that now. Let's look at this case scenario. Let's look at this since 2004. If basically in 2004 you had $100,000 and you invested into the S&P 500 and you left it invested going back to 2004 all the way till now, you will have $717,000 if you started with $100,000 and never sold off. Make sense? Now, let's look at this. If basically you win cash in between March 9th of 2009 to March 9 of 2010, you win cash for 1 year. Basically now you only have $416,000. So now your average return went from 10.35% annualized to 7.40%. What is that telling you? You're losing 30% of the gains. That's a lot. I'm gonna throw you a curveball. Let's assume this. You invested into the market in 2004 in December, but you went cash. You went cash basically with everything that was happening. You went cash in 2009 in March, and you never got invested again. So you took a loss basically of $30,000 and you stayed cash throughout the remaining of time until right now. You would have gotten left off with only $72,000. You took a loss, and then the returns historically of money markets and savings accounts was not there to make up the losses over that time, over the last 15 years. That's very concerning because that's you only missing 1 year. Let's make it a little bit worse. So let's look at this over here. Let's take it back more recent. Let's look at basically 2014. Going to 2014 in December, if basically you would have invested $100,000, the S&P, if you would have gotten invested the whole time, never went cash, you will have $342,000. Remember what happened in 2020? COVID. A lot of people got scared. There's a whole pandemic out there. Your average return annualized would have been 13.10%. Let's look at this. I really want you to understand this. If you would have gone cash on March 24th of 2020 and gotten back into the markets on April 23rd, within a month, your return basically, instead of having $342,000, you have $299,000. Your return goes from 13% to 11.59%. It's a big deal. But now, let's assume you went cash. Market went up. You experience this bull market right here. Then COVID happens. There's a whole pandemic out there. I don't want to stay within the market. I went cash. Then at that point, you will have $148,000, an annualized rate of return of 4%. I recently met with a family that they've been trying to time the markets over the last couple of years, and there's always something. There's always something in the news that avoids them to getting back into the markets. And I have met with a couple of families like that. They're not clients, but as you guys could see, because they basically believe that timing the market is the best thing. We don't really believe that because we don't have the crystal ball. The idea is that you understand how your financial plan is structured. And with proper structure, you're prepared for times like this. So if your financial plan is structured properly, you'll be ready for times like this. Because as we meet with our clients, we let them know what's going to happen when the market goes down 20%. How would that make you feel? If you have $1 million, market goes down 20%, now you have $800,000. It takes a larger percentage of return to get back to the breaking even of $1 million. And if you go cash, that's one of the worst things that you could do. So going back to those families, timing the market is very tough. And even the big hedge funds can't do it. Most of them don't make money. So Warren Buffett says it himself. You can't really time the markets. That's why you have to understand how's your money invested. So let's go into this. I really like this chart right here. It's an amazing chart. So with no reward, there's no base. Without risk, there's no reward. So let's look at this. The stock markets have had an annualized return of 12%, going back to the 1980s. But the average drawdown during the year, let's call it the average pullbacks of the market throughout the years, has been basically 14%. Let's look at a case scenario. Let's look at 2015. Market went down 12%. You sold at the bottom of the markets. The market ended up that year up 1%. Let's look at the following year, 2016. Market went down 11%. It ended up the year up 12%. Last year, the market had basically a mini correction throughout the summer. It pulled back very fast. I was meeting with families, reviewing their portfolios and their financial plans. They were scared, which is normal, but they understood the way they had the money position was not really affecting them in their financial plan with their goals. That's why their money has a purpose. You have to understand that when the market goes down and you want to go cash, that's not good. That's affecting you long term. You can let those emotional decisions affect your financial plan. So really understand that historically, the average intra-year drawdown of the S&P 500 is 14%. That's a huge percentage, and people don't think about that. So you're risking it. You're risking 14% throughout the years, but the average return is 12%. You have to understand how that is structured with your portfolio. So let's look at this. What the history tells us, bulls versus bears. So bull markets and bear markets. As you could see, the green, very simple, bull markets, the red, bear markets. So there's more green than red. As you could see, the gray areas, those are recessions. So look at this bull market right here. And then there was basically the dot-com bubble right here. It did 582%. That's a huge percentage. So people tend to think, hey, Miguel, there's going to be another recession. There's going to be another bear market. There's always going to happen. You have to give it time to the portfolio. Basically, a correction happens every year and a half where the market goes down more than 10%. The market goes down 20% every 4 years. History tends to repeat itself. You have to prepare yourself for those moments. And the bull markets, basically, hey, they're great. But even during the bull markets, the market is going to have a little correction of basically 10 to 15%. It happens very often. You just basically don't realize when that's happening. And when the market is pulling down and the news are putting fear in front of you, that tends to make bad decisions. But I'm looking here at the live to see if there's any questions that I should answer. So why, I see a question here. Basically, does going into a money market in times like now, does that make sense? So let's go back to this. If, let's assume this person that asked me the question was invested back in 2014. They had all this rally right here. And again, they sold off at the bottom of the markets and they stayed in cash in the money markets. Back then, money markets were not paying 4 to 5%. Interest rates were low. They were paying less than 1.5%. Money markets today, they're paying a little bit less than 4.5%. But that was not the case back then. But if you would have gone cash and put your money into a money market, basically at that point, that would have made your annualized return 4%. And you're timing the markets. Going back to this, if you miss the bounce of the markets, you're leaving a lot of money in the table. I'm not saying to have all your money in the stock market. I'm saying to have a structure to your portfolio and understand that the portion that you actually have it in the markets in a diversified portfolio, you cannot basically get in, get out. Also, that's not tax efficient. So depending on what account you have to think about tax location as well. Asset location, that's not really tax efficient. You're triggering unnecessary taxes at that point. So I'm going back to basically this year over here, COVID, 1 month, you would have gotten out the markets. Instead of having $342,000, you would have had $299,000. That's a big deal. You're dropping your average return by 2%. That's a big deal. That's a little bit more than 20%. Now, for our clients, basically a process and a financial plan basically beats performance. Not if, but when this happens, that's how we tell our clients, how do we prepare for moments like this? So how do we prepare? Like I was mentioning throughout the webinar, you have to give the money a purpose. What is that purpose? You have to diversify your money in different buckets. That's why you have different buckets for different purposes. These two over here, we like to call them luxuries. Now everyone needs these things. If you cannot afford it, you can have it. Basically, at that point, those are things that we may have to look at all the things. Now, when you're looking at the safe buckets, going back to that one client that asked, bonds fall within the safe buckets for times like now. Clients that have fixed index annuities fall in times like now. The market is down. You don't lose money in those buckets. Medium, think about gold, silver, long-term bonds, short-term bonds, structured notes. Those things for times like now, they're doing their job. They're minimizing the downside of your portfolio. Now, the risky bucket right now, which is meant for that, to make more money, this is the bucket that's getting affected. So if you have, for example, let's call it $1 million, this bucket right here might be up 1%, 2% if you have bonds, if you don't have bonds, depending on what vehicle you have, or it might be staying flat. And out of your portfolio, you have in the risky buckets, basically $200,000. You have an 80-20 split or a 60-40, and the market is down 20%. You have to understand that not all your money is down 20%. Only 20% is down in the risky buckets. And what is the equivalent of that 20% of the loss of the $40,000 in this case scenario, 200 grand in the markets, 20% is basically $40,000. You're down 4% of your overall assets. That's why you can't put all the money into one single thing. You have to have it spread out with a different purpose. And that's where time horizon plays a big deal. How long do you have until you have the need of this money? So when we're building plans, we set up different time horizons, different purposes. So depending on that, that's why you're withdrawing from these accounts. So if the market is down right now, your risky bucket, you might not be touching it. You might not need it for right now. You might have to withdraw from the safe accounts. When the market is up, you're eating from the gains of the risky buckets and so on. But here's something that I know today we talked mainly about investment management. That's one of the pillars that we cover here in Guerra Wealth. We have all the things that we cover. Right now, tax planning is a big deal. Like I mentioned earlier, when the market is down, you could look at tax loss harvesting, Roth conversions. If they make sense, you have to sit down with a wealth planner and a financial planner to see if right now in your current situation, those are Roth conversion or a tax loss harvesting situation makes sense. And the retirement income plan, that's why it's done for times like now. You have to understand where are you withdrawing your income when the market is down. And now, I hope you guys like the webinar. I'm going to go ahead now and answer a couple questions. Here's the beautiful team that we have. I'm just blessed to be here as a voice for today. For you, I know you're not only working with me, I know a lot of the clients know me, but here basically all the advisors, we have a great team. Our staff has been working very hard over times like this, basically because we don't want to, when the market is down, there's a lot of people that hide away. We don't want to hide away. We want to show our clients the value and the information so they understand what's happening right now and give the face at the end of the day. So let me basically go over some questions and we could wrap it up. So, and by the way, here's a QR code. If you want to have a session with us, one of our financial planners, you can scan this and book it. If you're one of our clients and you haven't had a financial review over the last 3 months, right now is a great time for you to sit down with your financial planner to review your portfolio, your overall picture. In other words, how your bucket's looking like right now, and is there a need to make a change? But let's see if there's any questions. So I could go ahead and answer. Let's take a quick look here. So yeah, we went over basically the money markets, going cash, timing the markets. We spoke about the sectors, how the sectors basically performing. I did answer that already. So very good question. Someone that's very close to retirement, what do they need to be doing at a time like this? So if you're someone that, for example, is going to retire this month and you didn't have the right, let's call it, financial plan, and all your money was invested into equities, my best advice to you is to sit down with a financial planner. At a point like this is money that you need to survive. You want to make sure that the right plan is set up for you, because right now, as you're getting closer or you're retired, you're withdrawing from this money. There's a risk called sequence of returns risk. If you're withdrawing from your portfolio and the market is down, you're setting at a loss, and it will take more money, a bigger percentage of returns, to basically make up the loss within your portfolio. So that's very important to know. So My advice to you is, hey, sit down with one of our financial planners so they could review your situation, how your buckets they've been doing, if you have any buckets, and then they could give you some guidance. Remember, we're a fiduciary financial firm. The goal is to give as much value as we can. And let's see if there's other questions over here. So what opportunities are there? So I see the picture. This looks like a younger individual. So let's talk about that. Opportunities. So this person seems like they're in the 30s. So someone that's closer to retirement, different situation that this someone that's in their 30s to 40s. And if you're in your 40s and you look like that, props to you. Send me the cream so I can put it on my face. So someone that's younger right now, let's call it mid 30s, it's a great opportunity. Right now, you have a lot of companies out there that value companies that they're at a discount. So it's a good time to invest. When the market goes down, don't time the markets. Don't think that tomorrow is going to go down. So let me keep waiting. Dollar cost average, you're waiting, which means at different times, you're buying into the markets at different prices. But statistically speaking, if you have a lump sum, historically, when you add that lump sum into the stock markets, it tends to perform better. Because dollar cost average, if you want to get your way into the market little by little, you cannot as well timing the markets. So if you sit on the sidelines, adding X dollar amount monthly, and you miss that great day today, let's look at the accounts today that the market did so good. Basically, you left a lot of money in the table. And who's to say that another day like this, which has not happened going back to 2009? So think about that. A great day like now has not happened going back to 2009, where the market did more than 7% in one single day. Very good day. So someone in the mid 30s, look into a very diversified portfolio you could afford to take, depending on your situation, your financial goals. This is not financial advice. Sit down with one of the planners. It might make sense to look into the market at sectors, depending on what you're looking for. Sectors are at a discount right now. And depending on your time horizon, it could be a very good time. So I'm looking at all the questions. Ba, ba, ba. So should I invest more into the stock market? What do you guys think I'm going to say to that? So right now, going back to the same thing, I don't know your current situation in per se, but there's some when you look at the stock market right now and you zoom out, right now we're at a dip right now. So you have to basically understand what is the purpose of your money? What is the purpose of this money that you have right now that you want to invest, seems like, and what is the goal behind that? If you want to buy a house with this money within the next year and a half, this might not be money that you're putting into a high risk portfolio. Because if the market goes down 20% like now, you have $200,000 needing to buy a house. Your portfolio now could be down $40,000 when you're in need to use this money for the purchase of a house. So be very mindful of that. Depending on the goals that you have and the purpose of this money, that's what type of risk you should be taking and what type of purpose you should be giving that money. Let's take a quick look over here. So I'm looking at the live chat to answer any questions you guys might have. I will answer a couple more questions. Ba, ba, ba. So let's see. Questions you guys might have. I think crypto. I just saw a crypto question. So when it comes down to crypto, right? So crypto is a high risk asset at the end of the day. Crypto is very volatile. It's an asset class at the end of the day, but you have to understand again, what is the purpose of that money that you're putting into crypto? You might not want to put all your money that's meant for retirement into crypto. If you're willing to take the, let's call it volatility into crypto, just understand what percentage of your money you're putting into that. So again, it's very tricky. So I know I have some people that I meet with, they're crypto lovers. I'm not gonna talk bad about crypto. That's not my job. It has performed very good. But at the end of the day, again, depending on your current situation, you have to understand what type of risk that could implement, because crypto right now is down as well. Over the last day is up. But again, it got as high as $100,000 Bitcoin. It got down to 75,000. It's very volatile. What is the purpose of this money that you have right now that you want to put into crypto? So, and if you're looking to diversify your portfolio into crypto, just understand what percentage of your money is going into crypto and what does that basically mean to your overall financial picture. I'm sorry. So let me see any other questions. Um, Yeah, we have a couple more minutes. So So how should someone that's close to retirement with all the political talk that's happening right now readjust their portfolio? Very good question. It goes back to time horizon. And depending on that, right? So let's say you're 65 years old and you had all your money in the stock markets, meaning you had all your money in equities. Going back to this, you had all your money in basically the risky buckets. So if you had all your money in the risky bucket, that tells me that you didn't really have a plan. You had all your money exposed to the stock markets. So this could be a learning lesson. You have to basically diversify the money. So, and as you're getting closer to retirement, you have to tone down the risk of your portfolio. So basically, you guys have heard of it, a 60-40 portfolio, 70-30, depending how close you are to retirement. There's rule of thumbs that we follow of how much of the money should be in the risky bucket and how much of the money should be in the safe buckets. So if you're closer to your 70s, at least 60 to 70% of your money, depending on your risk tolerance, should be in the safe buckets, and the other 30 to 40 should be in the risky buckets, just depending. How's your risk tolerance? Should dollar cost average be a critical strategy in a volatile market right now? It's good, depending, like I said, on your time horizon. He looks like a younger guy again, someone like yourself, younger, could be looking into buying into the markets. Right now, it's a great buying opportunity. Seems like you're in your 20s, and which is good that you're watching things like this because you're starting earlier, and the earlier you start, the more money you make. So absolutely, dollar cost average, someone your age seems like a good time. The earlier you start, the more money you make. That's why I tell all my clients, hey, they teach your kids, start earlier. They're going to have a huge advantage. They have you teaching them how to save and how to prepare for retirement, because they might not have to retire at age 62, 65, 67. They could have the option, if they want to keep working, to do so, or they could have the option to retire in their 40s or 50 with the proper planning. But yeah, absolutely. But that's pretty much it, guys. I'm gonna wrap it up. Going back to this, it's been a pleasure to be here in front of you guys, giving your information. I hope that I provided some value and guidance. Again, just understand where's your money located. What are you going to be doing basically with your financial plan? What's happening with your financial plan? And if you're not a client of ours, you could click that QR code as well, book a session with us, and we'll map out a retirement plan for you and see. Basically, it's like a physical. When you go to the doctor, we're going to see how you're invested right now. And then we're gonna give you some feedback, what should be happening right now. And hey, if you're doing a great job, thumbs up to you. We'll tell you as well. But again, it's been a pleasure being here tonight with you guys, and I hope I provided some value. And I'll see you guys around. Thank you.